So as I stated earlier, the downside to selling straddles is the unlimited risk and the margin. If you try to sell straddles, they're going to cost you a lot of money. You're going to have to put up a lot of money while you're waiting to make your money through time decay. So this can tie up a lot of capital. And so what you need to do then is you can simply buy the tails. If you sell a straddle, you can buy tails that are out of the money in order to protect the position. So for those of you starting with not a lot of money, it's imperative that you purchase the tails because the margin can be extremely heavy. The margin on a short straddle can be 50% of the stock price, which can be a very heavy amount, and it can limit what you do with your capital. So what do? We buy the tails. If we sell the at-the-money call and the at-the-money put to sell the straddle, we can then buy an out-of-the-money call and an out-of-the-money put in order to hedge ourselves. And notice what we then have done. We've sold a straddle and we've bought a strangle. So for those of you that didn't know this, a short straddle and a long strangle is simply an iron butterfly. And this will now get you, for those of you that have ever heard the joke, what's the difference, the beginner always asks, what's the difference between a straddle and a strangle? And the answer is an iron butterfly. And it's supposed to be funny, but the beginners never get it. So now you know where the joke comes from. I just, anything I can help out with, I'm glad to do so. So if all you get out of this is that you now understand the old joke, I'm happy. So what we've done is we've bought a strangle in order to help hedge ourselves in case the market goes too far against us. We've now been able to limit the risk. But the goal is still to keep the majority of the credit in the iron butterfly position. Okay, we still want to keep as much of the credit as possible. And in order to do that, one of two things is going to have to happen. Either the stock is going to have to behave perfectly, which is something we cannot control, or as the stock moves and threatens to get out of our range of profit, we're going to have to employ the use of reverse gamma scalping to help put the position back, to help keep the position within our range. Okay? So again, we cannot control where the market goes. Okay? If you haven't figured it out yet, try it one of these days. We can't control it. Okay? But what we can do is we can control the type of trade that we place, and we can control the types of things that we do as the market is moving against us. And that's what reverse gamma scalping allows us to do. So when do we reverse gamma scalp? The obvious answer is when volatility levels are high and you have reason to believe that they're going to decline shortly, that's a good time to reverse gamma scalp. These things typically happen when the market either advances or stabilizes. As you can see from the volatility index, this is a graph of the VIX, and yeah, when the VIX was at 80, that was probably a good time to reverse gamma scalp your position. The beautiful thing is I'm showing you a graph of what happened in the past. So this is one of those common trader mistakes we tell people not to do. Obviously, if we look at the whole chart, then yes, obviously selling at 80, reverse gamma scalping when the VIX is at 80 is a good idea. Of course, if you didn't have access to what happened in the past, to what happened after that point, maybe you would have thought that when the VIX got to 60, that was a good idea to sell, and when the VIX got to 70, it was a good idea to put on a short straddle. So again, we'll never know when the best time, when volatility is at a local high. But what we can do is we can take a look at a volatility chart, maybe for the past 3 or 6 months, to try to get an idea of when we might place a position. And that's what we would do here. We'd look at the volatility index, and maybe we're not going to place a trade when the VIX is at 80, but maybe we're going to place a trade when the VIX is at a higher level than where it's been. And that's what we're looking for. If we have any reason to believe that the markets are going to stabilize, or that the market's going to stop dropping, now it's a good time to possibly put on a position and use reverse gamma scalping to help offset some of the risk that you're going to see in a short straddle or iron butterfly position. Okay, so there's a lot of theory that I've thrown out, and I think the best way to really learn this stuff is to throw an example at you. So what I'm going to do now is I'm going to take you through an example of how to use reverse gamma scalping. It's going to have a lot of pieces to it, and I know that it can get a little bit complicated, so that's part of the reason that we're giving you guys the slides. I've heard a lot of people say, wow, you know what, I've heard this explained a lot simpler. And one of the things you got to be careful with is reverse gamma scalping can get a little bit involved. Okay, and sometimes the details are the beauty of the technique. So anybody can simplify things. All you got to do is take stuff out, right? Just like an engine. Okay, you can build a simpler engine. All you got to do is take stuff out. The problem is most people take enough out that it doesn't work anymore. So you got to be careful with the notion of people claiming to simplify when all they're doing is taking important pieces out and telling you they're not important. I mean, what do you know about cars? So let's go through an example to actually show you how the technique really is implemented. Suppose you've been watching IBM and you wanted to place a trade to sell volatility. Okay, you think volatility's high. You think it's higher than it's been. You think it's about to revert back to some lower level, and you think to yourself, maybe I can sell volatility and make some money, not only through the volatility crush, but also through time decay. So you think that the market and the stock have possibly hit a bottom, and even if it's only a temporary one, you think that the stock is bottoming out close, $75.97, close to that 75 strike. So what do? You sell the 75 straddle. And lo and behold, the 75 straddle is trading for about $13. What does this mean? It means that if the stock settles at expiration at at $75, you stand to make the entire 13 bucks. Now, let me walk you through a certain mindset here, okay? And let me make it clear to everybody in this room. And there are very few absolutes in trading, but I'll make this one of those that you should shoot for. You're not going to get to, if you sell the straddle at $13, you're not going to keep the whole 13 bucks. Okay, let's just be clear on that. Something will get in the way. The way the stock moves will be something less than perfect. And therefore, you're not going to keep the whole 13. In fact, don't even hope that you're going to keep the 13. You're trying to make money. Okay, you're trying to keep as much of the 13 as you can, but make sure we go into this with the understanding that some of the $13 will be lost as a casualty of trading. We're trying to capture as much of it as possible. We're not going to keep all of it. Okay, so it's okay to lose some of it. I just want to make sure you guys understand, because I know that when a lot of people, especially when people get introduced to credit spreads, people tend to feel this entitlement that they have to keep the whole credit. Okay, and a lot of times in the education, people are sold on the notion that they have to keep the whole credit, which in and of itself is not true. But since it works out enough of the time, people are happy with it.